In this problem, we're going to start with doing the schedule of cost of goods manufactured, and then we'll move into the income statement and then do some what-if scenarios for questions 3 through 5. So I'm going to start with the name. So it's Merriwell Company, and I'm doing a schedule of cost of goods manufactured. And this is for the year ended, I don't know what year this is, or month or period. So I'll just say, let's just pretend it's for the year ended December 31st, 2022, just so we can assign a date to it. So since the format of all of our schedules for the cost of goods manufactured is the same, I'm just going to re-implement the template starting with direct materials. So I have my raw materials inventory beginning, and I look through my list and I can see it right here, raw materials inventory beginning. And I'll just bold this, so once you use the number, you don't use it again. Then I'm going to add my purchases of raw material. So just imagine that we are in the T account for raw materials. And I'm just going to try and find my purchases here, and I see them right there, so that's 125. And I just have to make the column bigger so I can see the number. And then add those two together, and that is what we have available. And instead of putting my line like that, what I'll do is I'll just use the lines there. So I'm just using this box here. Now I'm going to subtract out my ending inventory. And that's the 6,000. And I will end up with raw materials used in production. So remember, your total manufacturing costs are your raw materials used plus your direct labor plus your manufacturing overhead. Let's try and subtract this again. There we go. It's 128,000. And I'll bring these ones in, and maybe I'll just put this as a bold. Now the next number that I'm looking for is my direct labor. Remember, I don't have its own T account for direct labor, but you do have a wages payable account. So this is where you would remove your direct labor and you'd remove your indirect labor. So the direct labor here is 70,000. And now let's go ahead and figure out what all of our manufacturing overheads account, all of our manufacturing overhead costs are. So remember, these are all of the indirect costs involved with making the product. So I'll just start from the top. Those are finished goods inventory account, so it's not that. This one here, depreciation factory. Because it says factory, I'm putting it down here. If it just said depreciation office, then that would be period cost, and we'll see what we do with those when we put the income statement together. Okay, administration expenses, that's a period cost. Utilities factory, that is a manufacturing overhead cost. And again, I'm cluing in on it because it keeps saying factory after it. Otherwise I wouldn't really be too sure. Then I have maintenance factory, so I'll put that one in. I've got supplies factory, so I'll put that in. I have insurance factory, so we'll include that. Indirect labor, that is a manufacturing overhead amount. These are inventory accounts, so I won't include them under this heading. Sales, that's sales and selling expenses, that's a period cost. So I believe I've got all of my manufacturing overhead costs, so I'll just add those up. And that is total overhead costs. Now, if I add my direct materials used plus my direct labor plus my total manufacturing overhead costs, that will give me my total manufacturing costs. And that's those three added together. So just remember, the difference between total overhead costs and total manufacturing costs is the total overhead costs is all of the indirect manufacturing overhead, and the total manufacturing costs is the total overhead plus the direct labor plus the raw materials used in production. So now we're going to go into the work in process account. So we need to figure out what inventory is in here already. So at the beginning of the period, there was 17,000, and we are in the process of making 303,000. So we'll add those two together. And then if I take out my ending inventory, so work in process inventory ending, that will tell me what I finished. So that would be my cost of goods manufactured. And I'm just going to put a double underline on this because I've done this report. I'm going to put bolds on those because I've already used them. And because this is in good form, $ for each column you use, and then at the end of the schedule. Okay, so my next piece that I need to do is my income statement. So this should be familiar to you because we've done this in financial accounting before. So the finished goods account is the account that we're used to when we used to buy and sell a product, but this time we're manufacturing the product and selling it. And I'm pretending it's December 31st, 2022. Okay, so we'll start with our sales, and that's 500,000. And now we have to figure out what our costs of goods sold are. So we can start off with our finished goods inventory at the beginning. So this is how much we completed, but we didn't sell. Well, let's see here. So that's that number there, the 20,000. And now if we add in what we completed this period, that's the cost of goods manufactured. And we'll just grab it from this schedule up here, the 290. Then the beginning inventory and the cost of goods manufactured is how much we have available. So this is the completed product that we can sell. So goods available for sale. And then if we subtract out our ending inventory, which is this 40,000, then we end up with our cost of goods sold. So 310 minus 40, that's cost of goods sold. And maybe I'll just put this as a negative because I want you guys to know that that's an expense. So when I'm having to calculate my gross margin, I'll take my sales and subtract the 270. So that comes to 230. And now I'm going to subtract my operating expenses. So these up here are known as product costs. So these are all product costs up here. And now what I'm doing is I'm listing my period costs. So I have, let's see here. Those should be in bold because I see that I used those ones up there. So I have administrative expenses. I'll put those down here. And that is 110. And the only thing that I haven't put as a bold is this one, selling expenses. So those go here as well. So these are all of the other expenses for running the business. And again, I'll put that as a negative just because I want to subtract it from gross margin and it's easier for you to see that that's an expense. So I'll put expenses in as brackets. And then I'll call this net income. So sometimes you refer to this as net income, operating profit, earnings before interest and taxes. It's a lot of different names. So 230 minus 190 will give me my net income of 40,000. So again, different questions and different companies might have different types of manufacturing overhead costs, as well as they might have different types of operating expenses. So aside from having those with different names, your schedules and your income statement are always going to be the same format. So in number 3, they're just having some fun with us. They're asking us what was the average cost per unit for direct materials. So what I can do is maybe just right beside the schedule, I'll just say unit cost. And the unit cost that this information was based off of was 10,000 units. So maybe I'll say units right there. So if I want the cost per unit, then I'm going to look at my direct materials. So that would be, I believe, off of this number here, my raw materials used in production. So if I take that total and I divide it by the number of units that I produced, then the cost per unit is $12.80. And that's important because a lot of questions may ask us for the answer as a total for all of the units, or they might just ask us it for a total for one unit. So we need to be able to do the conversion. And then the next one in number 3 says, what was the average cost per unit for factory depreciation? So I'll just highlight this one. So that's the factory depreciation. So I'll do the same thing. I'll take 27,000 and then divide that by the units produced. So that gives me $2.70. So you can do that off of any amount that we have listed on our cost of goods manufactured statement or our income statement. So in part 4 it says, assume that the company expects to produce 15,000 units of product during the coming year. What average cost per unit and what total cost would you expect the company to incur for direct materials at this activity level? So the easiest way to do this is to put 15,000 right beside here, and then we can do that analysis. So at 15,000 units for my direct materials, it's 12.80 per unit. So if I do 12.8, so that won't change because that's a variable cost. So the unit cost won't change, but the total cost will. So if I multiply it by 15,000, then that comes out to $192,000. So again, the variable cost changes off of the volume. So at 10,000, my total production was 28, and at 15,000, the total production is 192. So in this instance, I took 10,000 times 1280 to get that number. And then at 15,000, I took 15,000 times 1280 to get that number. So if you sell more units, you're going to have an increase in your raw materials produced. So then the second one is asking us, what would it be for factory depreciation? So let's look at the factory depreciation. So this is known as a fixed cost. So it doesn't matter how many units you sell, we're always going to have $27,000 at 10,000 units and at 15,000 units. So in this case, I'm just going to type in 27,000 here. And if I want to know what that unit cost is at the $15,000 level, I'm going to take $27,000 and divide that by 15,000. So you'll see that on a per unit basis, fixed costs will change. But on a total basis, fixed costs stay the same. And then the opposite is for variable costs. Their unit cost will stay the same, but their total cost will increase or decrease based off the volume. So that's just the difference between a variable cost and a fixed cost. So I actually just answered number 5, where I'm trying to respond to the manager and explaining them the difference between 3 and 4. So that does get into our discussion about variable costs and fixed costs. Variable costs per unit change. The total number changes when we increase or decrease the units. So those change with volume. But the fixed costs will stay the same for the total amount, but then the unit cost will change because of that. All right, I think we're done.